Good morning, ladies and gentlemen. By my calculations, the risk dial is now at neutral. The next few weeks are going to be absolutely key, and I would have thought that the big date is going to be the 12th of August when we have the next CPI. And now let's have a look at why it's going to be key and also what the bond market is most likely to do. I think that everyone's noticed this so far this year, that what bonds do, equities follow. So without further ado, let's have a look at what was decided by the Fed and what was not decided by the Fed this week, and how it might affect prices in the near term. Before we have a look at each individual tenure and the yield curve in detail, I think this is very important. I've included this in the summary sheet. This is where I think we are, and this is also where Dudley thinks we are. So, which is even more importantly that where I think we are. This is Dudley's interview. I completely agree with what he said. I came to the same conclusions quite independently of him, but when I saw him, basically it was like an echo chamber, exactly what I think. We are not at restrictive. We will be at restrictive after a 50 basis point hike. And that, even that can be argued with, because nobody really knows where the R star is. We can guess that R star is 2.25%, 2.5%, and why not? But we are not at restrictive now, we're at neutral. We will be at restrictive after 50 basis points. The bar is high for anything other than 50 basis points, but that does not mean that if data does not warrant it, they won't do more than 75. But I think this is also key. There is no way they cut rates as quickly as the market now thinks they will, and I think that will affect equities later on. But it will be data dependent. I mean, I could be completely wrong. Dudley could be completely wrong. Inflation could absolutely collapse. How likely is it? Not very likely. But if it doesn't, I think the market would readjust in a very violent way. Please watch the interview. It's very, very interesting. And this bit from 3:15 minutes onwards, I think, is key. So what did the yield curve do last week? Well, in the 2s, 10s, absolutely bugger all. And it's still, comfortably below the 10 area, where I think, minus 10, where I think there is a swing point. While it remains below minus 10, I would have thought that the whole of the yield curve can't do very much, even though 530s are doing something, and I will show you that in a second. But as long as 2s, 10s stay below minus 10, the likelihood is that we at some stage go towards the minus 50s and minus 60s. That is the probability range. The one part of the yield curve that did move last week was 5s 30s and 10s 30s. 5s 10s not so much, but let's have a look at the weekly chart of the 5s 30s. And we were very close to zero when Chairman Powell spoke, and we actually ended up the week at minus 28. Likelihood is that we go down towards the 40 area, 40-50 area, and then bounce. But if we have a look at the daily, it's not so clear. I really wouldn't put too much money on it. I would have thought that these levels, minus 45, minus 50, are actually very good levels for a swing back up. We will have a look at why that happened earlier. I think the reason is that people just got stopped out of positions. So many people were in the 530s trade that they got stopped out. And this is now the weekly 10s 30s. And you can see that if we get down here to minus to around 40 basis points, I think I'm going to be a very decent buyer. I think the likelihood is that we swing higher again. People have been basically stopped out of their yield curve plays. And actually, that is the pause that refreshes. Far too many people were looking for the flattener. Every podcast you listen to, people with far less experience than me were looking for the flattener. Well, no, the market already had flattened in anticipation, and then it just stops them out. Doesn't mean that the yield curve will not re-flatten. It just means that it needs to stop everybody out before it does so. So what did the individual tenures do last week? 5 stopped exactly where I have my support, to 68, let's call it, to 67, to 68. If I enlarge this area here, we can see where we are. If this is going to be some sort of an ABC retracement, we could easily go down to 240. But I would argue that the risk reward from that area is actually massively to the upside, and I would love to see it. It will fill all these gaps technically, and this is where we were at the beginning of April. The Fed is not going to like it, and then the risk reward for a move back up to 3 is huge. What should the market do? The market should do what it did here, i.e. trade between just below 3% and this 268 area for a protracted period of time, certainly until we see CPI. But the markets being the markets, it just pushes and people get stopped out of positions. And since everybody was basically short the 5s and long the 30s, this is what you get. You get these outsized moves which have actually very little fundamental reasons for them, but that's what you get. I think it's, I would love to see a move back to 239, 240. The risk reward there is so hugely tilted to the upside, it's not even going to be funny. So, the market should do this. It could do this. If you get daily closes below 268, you are very likely to see an extension down here where you basically go berserk for the upside in terms of puts on futures, put spreads, outrights, whatever you like to do. You can see how it respects these levels very well. It didn't close on Friday below, so I would expect that it's just going to churn for another week waiting for the CPI. If you look at the 10s, people were short and people basically stopped it out at 261. Do I think that is impulsive? No. But do I think that a move down to here, down to 234, 235 is a gift? Absolutely. It's such a gift, it's not true. Will we see it? I have no idea. All I know is that I would bet from here going up far more than I would bet from here going down. And the one that tells me that things are not impulsive, but it's just the yield curve and people being stopped out, is the 30s. They just could not break the 294 level, touched it 3 times, nothing. I think that as long as they anchor any move in the 5s and 10s to the supports I just showed you is a gift. I think the 30s are the least likely to break down, and therefore I think that we are in a trading range in the 30s between 294 and just above 3%, 310, 315, this kind of area, 308. I don't think they're going to move next week. No reason for the 30s to do very much ahead of CPI. In Europe, I think that we are in much the same position as in the US. These are the twos, the shats. Can you exclude a move down to 8 basis points or something like that, where this previous range support was? No, you can't. But what you can say is that the risk reward of a move higher from there is overwhelming. Nobody's going to tell me that the ECB is going to go back to negative rates anytime soon. That is just so unlikely that, it's overwhelming risk reward at around 9 basis points. That gives you a top just above 109.50 in the shats. If we move on to the bobble, could we see a move here to around 34 basis points, 35 basis points? Absolutely stops everybody out, and then it goes again. I think the risk reward, again, you don't need to, ask me again. It's just going to be overwhelming for stability for a certain period of time around here, around the 75 basis points. If we go to the 10s and the Bund, let's get rid of that. Could we get another move? If the 10s do what I said they might do, can we see a move down to the low 50s? Absolutely, but the risk reward becomes overwhelming there as well. So I would not, I'm an opportunistic trader in Europe at the moment. If it goes anywhere near these lower levels that I've just showed you, I am a seller of futures and options. The one that tells me that we could get that kind of a move is France, because France has been trading technically quite perfectly. If I see a move to 114, 115 basis points, that is my signal to swing the other way towards 160. Don't think that the Fed is not looking at this. It's looking at it very, very closely. As soon as the market started getting a bit dovish and started thinking that oh my God, the data dependency, blah blah, which is complete rubbish, is dovish. And what do we get? We get a spike higher in 5-year forward inflation expectation rates. And if we have a look at the 10-year break-even inflation rate, it goes down, it goes up from the 230s into the 250s. Or, so it's so very unlikely that lower yields, higher prices in the bond markets can be withstood for any length of time. It just is so unlikely. You play the risk reward. You see those support levels in yields, and you have to be short of bonds. The dollar finished the week slightly weaker as the rates came off slightly, but it's hardly an impulsive move. As you can see, if I enlarge this area, we could be in a retracement period of this whole move up. And I would have thought that this kind of area below 104 is definitely possible. This support at 102.82, I think, might get touched. But I think it's a very, very decent risk-reward area to look for higher prices again. If we look at what that means for Euro USD, my mind has not been changed. If we see this 103.40 to 104.37 area, it's going to be a very decent level to look for retracements back down towards parity and even lower. We are probably in a period, an A, B, C back up to here, which would touch that 102 something level in the Dixie. Why not go with it and wait for it? I think the risk reward there is going to be very, very good. With the dollar slightly weaker and bonds, having stability stroke doing slightly better, you remove the pressure on gold to go lower, and you give it the opportunity to trade 1810 again and possibly 1830. But between 1810 and 1830, I think is going to be a very good risk reward to look for lower prices again in gold. 1764 seems to be a very good swing. Since we closed above it, odds are that we can touch this 1810, 1830, but I really don't see it higher than that. I think 1830 is going to be a very good risk reward for the downside again, given my views on bonds, which it drive my views on the dollar, because if the yields turn again from those levels or from here, then both gold and the dollar are going to be supported. The gold is going to be sold, the dollar is going to be supported, and therefore I just can't see much higher prices in gold than 1805, 1810 to 1830. If I see 1830, I'm buying puts. DBC had a slightly better week. The fact that the dollar was a little bit lower allowed commodity prices to go up. I think it's going to be pretty much key if we can break 26.93 on the upside. If we can, I will be more and more convinced that bonds in all tenures can't go down at all in yield, and that they actually need to go up. But I think even that is unlikely. I think a few weeks of going sideways with 26.93 as a bit of a swing is more likely than not. If we have a look at what oil is doing on, say, a monthly, it keeps on holding this 97, 98 area, which to me indicates stability, something like this. It's unlikely that oil is going to give us and this is on a daily, it's unlikely that it's going to give us a very strong lead anytime soon. I think this 200-day moving average, which is around the 93, 94 area, back up to 105, 106, is all she's going to write. I don't think you're going to get a very good lead from oil in the next few days. It basically is at the same level that it was in early April, and basically rates are more or less at the same level as it was in early April. I think that you need to have several weekly closes below this 94 area to indicate the next move in oil, and possibly then that would lend credence to lower rates in bonds. But until that happens, I think it's very, very unlikely that we get lower bond prices. Gold against copper, it's not justifying any lower moves in bonds. It's coming back. I think it could easily come back to this kind of level, 10, which would to me indicate stability in bonds. What I showed you earlier, what it should do for the next few weeks in bond land, if we get this kind of retracement in copper against gold, is basically, if we go back to bonds, is basically this. yeah, a few days of basically trading, or even a few weeks of trading with 294 as the bottom and 310, 315, maximum 320 as the top. On the Blue Angels, well, they're finally flattened out, but not very much. Earnings have been quite decent. And is there a possibility that we go to times 18? Absolutely, we'll see those levels in detail on the S&P chart. But I think the risk reward from there is overwhelming for a move back down. So, the fundamentals are there to agree with the bond yields, to agree with the multiples. I think that we are so unlikely to trade over this multiple of times 18 that anywhere near it is a very, very good risk reward down. What does my bond view mean for equities? If we enlarge this and we have a look at SPY it's bounced higher. It's a relief rally, but I would have thought anywhere around 4 to 410, it's going to run out of steam. If we have a look at SPY TLT, I think these levels around 360 are going to be very good levels to reset shorts in equities. This is just a relief on behalf of equities that bond prices are not going higher, they're not leading them higher, and therefore equities could do slightly better. But I don't think it lasts very long. I think at these kind of levels, you are looking to reset shorts in equities. Okay, so in the S&Ps, let's see how it all marries in. This is a monthly chart. We're going to have a new monthly candle. We can enlarge this and see what it basically says. It says to me that this 41.81 area is going to be very, very key. And 41.81 to 43.95, I see 43.95 as a gift to the downside. I don't think we're going to see it. I think that anything around 4,200 is going to be a massive buy put spreads and leave them. All we had here was an inside month, and basically we are back where we were from April on. We are back to where we were in April on because bonds are basically where we were from April on. Now we have to decide in the bonds, and the CPI will be key, whether we have topped or whether we have not topped. But even if we have topped, the likelihood that the Fed will not hike at least a couple more times and disappoint the market as to when it will ease is going to be, to me, minuscule. And therefore, it's a question of how far we retrace down rather than if we retrace down at some point. Could we have seen the bottom? Absolutely, we could have seen the bottom. But I think that it's unlikely that we move higher for the time being, simply because Dudley told us, and I completely agree with him, if the Fed sees an outsized improvement in the market, it's going to be incompatible with its aims, and therefore is likely to hike higher for longer rather than not. And therefore the market going up is actually undermining itself, because the Fed will then only respond with a tougher measure, and if it responds with a tougher measure, bonds will definitely respond worse, and that will make the equity market actually fall harder. From a weekly standpoint, the really important level is 42.47. I haven't been bearish the S&P for quite some time, and the reason was that I was anticipating a kind of move like this. I started fighting it very small, but I will really fight it at 42, 47. You can just play this game. You can say that this was the bottom, that was retracement back down to here. Where do we go to? Well, we could be already, at overbought, but at 42, 47, you are definitely way overbought, and you are really beyond the levels that would make any sense for the market to be at. You'll be around that times 18 Blue Angel. You will be at all kinds of levels which are unsustainable in bonds, most probably, and therefore the risk reward at these levels becomes overwhelming to the downside. Whereas the equivalent risk reward point in NDX, well, it's clear. On a monthly chart, it's 13,860. That is where I will most definitely be short of NDX. Not before then, but at that point, definitely. NDX actually has done a far stronger retracement than SPX, of course, but I'm not telling you anything that you don't know. And the monthly Bollingers caught the bottom beautifully. It's actually done something that SPX hasn't done, which is taken out the previous month's high. So I think the odds are high that we go to 13,860, and that is why I think we've got a month to do it, and that is why I think that bonds could do what I showed you earlier and test those lower levels. That's why I'm not fighting them now. But if they go to those lower levels and NDX touches at 13,860, the risk reward of bonds moving higher and NDX coming lower from 13,860, I think are very, very high. In Europe, the levels are very, very clear as well. What a beautiful bounce off this 38.83. Now you're looking basically to get out 38.82 to 38.43, depending if you look at the weekly or the daily chart. I certainly would have thought that kind of level, coupled with 4,200-ish, just over in the S&Ps, coupled with that 13,800 level in NDX, is definitely where you don't want to know about Europe anymore. Volatility has been leading this move all the time. Whenever SPX was very weak and volatility wasn't spiking anywhere near as much, volatility won out and the SPX returned. If we enlarge this bit of chart here on the weeklies, you can see that we've been going down for 1, 2, 3, 4, 5, 6, 7 weeks. This kind of area around 17, 18 is going to be very, very key, and where this market, where volatility will have shown that it's quite oversold and where we can get a decent bounce from. I really would not fight this kind of move yet, and that is why I get some feeling that we could get to those higher levels in the indices that I just showed you, but when it gets to these kind of levels, it's time to fight it. Anything in the 17s I think is too low, and then we could hope for a return back up to at least 25. And that gives me confidence that my analysis in the indices is not a million miles out, that those higher levels are going to be very good levels to initiate or add to put spreads, and in the meantime just trade it. I have changed all the levels. Um, I really, all I want and hope for is that the fives and tens reach those lower support levels, and then I will be confident that actually everything will have topped in the indices, will have topped at those levels that I'm hoping for, and that the risk reward is overwhelming to the upside in bond yields, downside in bond prices, and that's going to drive XPX and NDX lower both from whichever level they happen to attain. I have, don't forget that I've given you here the clip with Dudley, which I think is, I completely agree with it. I didn't watch it until recently, and I thought I was in an echo chamber. Reached those conclusions completely separately, but he put it, word for word the way I would. So please watch it. Okay, thank you very much indeed, and tweet you on Monday.